How many REITs are there in the United States? The IRS says there's about 1,100 that actually file tax returns. Only about 220 of those are what we call publicly traded REITs. You can actually invest in non-publicly traded REITs. Those are 880 of those. They're not very liquid and they're very high cost relative to publicly traded REITs on average, and generally you should avoid them. So you have these two different types of REITs, publicly traded and non-traded. Publicly traded REITs can be relatively inexpensive. They have to, when they're publicly traded, they have to file annual reports, and you can sell them on the stock exchange. But non-traded REITs, basically, if you buy into them, in order to get out of them, you have to basically have a buyer for them. So most non-publicly traded REITs, once a quarter, will take in new investors' money and give it to departing investors. They'll match the sellers and buyers. That assumes, however, that you have buyers for it. And Barry Vindicore basically said, as a rule, non-traded REITs don't perform as well, and investors who buy them don't really understand them very well. Why is that? It's probably a large part because of the upfront fees associated with these. Um, when REITs issue shares, non-publicly traded REITs, they're sold through brokerage firms. It's very common for the commissions on these things to be 10%. So 10% of all the money that's being raised goes to the broker dealer. In addition to that, you can see marketing support payments paid by the REIT to the broker dealer firm that helps pay for seminars and things of that nature. Another 2 to 3% in essence. And that really contributes to the to the underperformance of these REITs. But another reason is basically these tend to be smaller REITs, and it's not this, they don't achieve as much economies of scale in terms of their management expenses and the like. And some of them are just quite frankly poorly managed. So if we look at that and we look at these high upfront fees that contribute more than half the shortfall between non-traded REITs and traded reclaims, this is over a certain period of time. 4% for non-traded REITs, 11% for publicly traded REITs in terms of the rate of return. Now, interesting enough, there was an article back around 2011 or so that led to a well-known REIT called Apple REIT, um, that was selling a lot of its shares through a particular brokerage firm in the states of New Jersey and New York. And An article was written about that REIT and the potential problems with that REIT. And the result of that, there was investigations being held by the SEC and by FINRA, which regulates broker-dealer firms, and both the REITs themselves were fined, as well as David Lerner Associates was fined and also sued by quite a lot of investors. Now, the question is, who wrote this article? I mean, who did all this due diligence? And the answer is yes, the Bear did it. I wrote an article about that. Interesting enough, this article was published, and at the time it was published, um, I was on a flight back um, from the West Coast, kind of one of those late flights back from the West Coast. And when I landed, and it was about 1 o'clock in the morning or something like this, and I turned on my cell phone, I had basically messages from three class action attorneys who basically wanted to sue Apple REITs at that point, and the David Lerner firm, and they wanted basically me to testify as an expert witness and the like, which I don't do for other reasons. It's just, but I did write an article that led to David Lerner actually ended up getting barred from the securities industry, as I recall, and the David Lerner firm is still out there as a broker dealer firm. A lot of the brokers left that firm, but there's still a lot there, and they're actually still selling a lot of Apple REITs, which is pretty interesting, even after all that big scandal and all the lawsuits that they had. It just shows that, hey, if you're going to sell non-publicly traded REITs and you're making 10% commission on selling them, it's kind of hard to avoid that, even though it might not be the best investments for your clients. Real estate investment trusts basically have had pretty good performance. I pulled this up very recently from this is the Dow Jones U.S. Select REIT Index. Is the longest data that I could find for a REIT index. And if you look at the rate of return relative to the stock market over this same period of time, uh, and you basically see that REITs just slightly outperformed that. The growth of wealth, $1 growing to $100, or $1 growing to $105 in the case of REITs. So a little bit more than the overall stock market. However, a lot of people used to say, hey, invest in real estate because it doesn't go down in value much. And before 2006 or so, that was probably generally true. There wasn't a big time that I could remember back in the 20th century in which real estate fell tremendously in value. I think you'd have to go back to the Great Depression for that. But uh, during the Great Financial Crisis, which was basically triggered by a bubble in real estate prices, which was triggered by a whole bunch of other factors. Basically, real estate investment trust and real estate investing generally fell very significantly, even a little bit more so than the S&P 500. So basically, real estate did turn out not to be a very good diversifier at that time. If you look at this chart, it breaks down REITs by sector, and the blue line is 2007, the red lines are 2008, the green is 2009. So you see in 2009, basically all REITs increased in value, rebounded significantly in price. Now remember, whenever you look at a chart like this, negatives are much more impactful than positives. When you get a minus 50% rate of return and you look and say, what does it take to break even? You have to have a 100% rate of return to break even. So those green lines, there was a rebound in 2009, towards the end of 2009, but it was not yet as significant in order to make up for all of that. You'll see that lodging and resort REITs, because people were basically not traveling because of the Great Recession at that time, did extremely poorly. Industrial REITs did poorly. Retail REITs, a lot of stores closed. Even offices, there turned out to be a lot more vacancies. Healthcare REITs pretty much held their own in this period of time. And healthcare REITs, you can actually break that down between uh, healthcare offices and hospitals, and you can also look at medical clinics, um, physical therapy offices, and then nursing homes. And nursing homes are kind of a distinct form of investing in healthcare. About 70% of all investment advisors recommend REITs to at least some of their clients. And most target date funds, if you were to invest inside a 401k and it has a fund that says, this is one fund that is appropriate for you if you're going to retire in 2065. Well, part of that fund, a small part of that fund, is going to be invested in REITs in some way. There are actually three types of REITs. There's equity REITs. Equity REITs means you're investing in real estate itself. Mortgage REITs, which invest primarily in mortgages. So they buy up a whole bunch of mortgages and they bundle them together. And then there's hybrid REITs or something in between. Now, most REITs are equity REITs, where you're actually investing in real estate itself. The number of mortgage REITs out there is not that significant, although it has increased in recent years because of a tax law change. The tax reform that occurred at the end of 2017 and was effective in 2018 basically says for certain shareholders of REITs that are held in taxable accounts, not IRA accounts, not 401k accounts. If you are at the top income tax rate, then you get to exclude 20% of dividends from certain businesses, including REITs, from that. So basically, if I owned a REIT and it generated, let's say, $1,000 of income for me, I could exclude from my income $200 and only have to report on my income tax return, at least for purposes of determining taxable income, $800 of that. That's a very significant tax advantage that happened. And as a result of that, basically the prices of REITs after that was enacted during the process of its enactment and thereafter, the value of REIT shares rose because of this basically fairly good tax break for REITs. You can buy a diversified basket of REITs by buying basically low-cost index funds. So Vanguard's got a low-cost index fund that basically says, well, if you don't know what REIT to buy, if you don't want to guess which REIT is going to be the best managed, why don't you just basically go out and buy almost all of them? They have 184 publicly traded REITs in this mutual fund. The annual expense ratio is actually a fairly low 0.12%, and the 10-year returns as of the end of February of this year was 11.29%. Very healthy returns over the last decade or so. Another fund is the Dimensional Funds Advisors Real Estate Securities Portfolio. Basically the same thing. It's a mutual fund that owns a whole bunch of REITs, in this case a little bit less, 155. Dimensional excludes, for example, nursing home REITs and some other types of REITs. The annual expense ratio is a little bit higher, but they've performed 11.75%, which is a little bit more than 11.29%. So if we look at real estate